Good morning, students. Today we shall continue the lesson Money and Credit. In the last class, we have discussed about first part of the lesson, that is money. And today we will discuss about the second part of the lesson, that is credit. What is a credit? Credit or a loan refers to an agreement in which the lender supplies the borrower with money, goods, or services in return for the promise of future repayment with the interest. Here, two parties are involved in the process of credit and they will enter into an agreement. Both the parties have to enter into an agreement. Here, the borrower promises to repay the loan which he has taken from the lender with interest. The lender can lend the loan either in the form of money, goods or services, and borrower uses that loan and he will repay that amount with interest. This is the meaning of credit. Now we shall see the situations of a credit. There are two situations of a credit. One is favorable situation and the second is unfavorable situation of credit. We will discuss about the favorable situation. In this situation, credit helps to increase earnings and therefore the person is better off than before. See the situation of Salim. Here, Salim has received order for manufacturing 3,000 pairs of shoes. The time given is 1 month. He has to hire some workers for this purpose and he must purchase raw materials. He asked the leather supplier, to supply leather on credit and promised to pay the amount in future date. He received some amount as advance for the manufacturing of 1,000 pairs of shoes. At the end, Salim was able to deliver the order within date and earned good profit. He repaid loan borrowed. Here in this situation, credit plays positive role and the situation of the person who has borrowed loan is improved. It is better off than before. His standard of living is also improved. Second one is unfavorable situation. In this situation, because of the crop failure, pushes the person into debt trap. See the example of Sapna. A small farmer grows groundnut in her 3 acres of land. She took a loan from the moneylender, hoping to repay the loan once the crop is harvested. Being hit by the pest, the crop fails. Expensive pesticides did not make any difference. Sapna is unable to repay the moneylender and the other year it becomes a bigger amount. Next year again she took a loan for cultivation. It is not a bumper crop this year too. Sapna earns little, but it is not enough to repay the old loans. She had to sell a part of the land to repay the loan. She is caught in a debt. This situation is called debt trap. Here, credit plays negative role and lowers down the position of the farmers. It pushes them into a state in which recovery of loan is very painful. Hence, we can say that it depends on the situation whether credit will be useful or not. Now let's discuss about the terms of credit. Interest rate, collateral, documentation requirements and the mode of repayment together comprise terms of credit. The first one is interest rate. If the loan amount is rupees 1 lakh and the rate of interest is 10%, then the borrower has to repay the loan amount 1 lakh plus 10% interest. 10% of the 1 lakh rupees 10,000. So 1 lakh plus 10,000, total 1 lakh 10,000 he has to repay to the lender. Here the amount rupees 10,000 is interest. It is calculated on the basis of the rate of interest, that is 10%. So rate of interest 10% and amount of interest rupees 10,000. Total the borrower has to repay the loan amount 1 lakh 10,000. Next term is collateral. What is collateral? Collateral is an asset that the borrower owns, such as land, building, vehicle, livestock, deposits with the banks, etc. It is used as guarantee to the lender until the loan is repaid. If the borrower fails to repay the loan, the lender has the right to sell the asset to obtain payment. Property such as land titles, deposit with the banks, livestock are some common example for collateral used in the borrowing. Documentation is the procedure to prepare the required papers or documents for the loan, which is containing the terms and conditions of a loan. If the borrower agrees for these terms and conditions, he has to sign the documents of a loan. This is called documentation, through which the borrower will repay the loan must be clearly mentioned. If it is a long-term loans, then it can be repaid in annual, half-yearly or monthly installments. For example, if the loan amount is 1,20,000 and mode of payment is monthly, then every month the borrower has to repay 10,000 rupees plus interest amount, total 12 installments. If the mode of payment is half yearly, then the borrower has to repay the loan amount in 2 installment, that is 60,000 plus interest. And if the mode of payment is yearly, then the borrower has to repay whole amount in 1 installment with interest. Sources of credit. There are 2 categories of sources of credit: formal sources of credit and informal sources of credit. Formal sources of credit include banks and cooperatives. These are the institutions which are regulated by rules and regulations laid down by the government or RBI. They charge low rate of interest and the mode of repayment is easy. Mode of repayment like monthly installments or half yearly installments or yearly installments are available in these sources of credit, and they keep a collateral from the borrowers for granting loans. If the borrower fails to repay the loan, the lender has the right to sell collateral or the security documents or assets, and they can recover the loan amount. For example, land titles, deposits with the banks, livestock are some of the example for collateral. Reserve Bank of India supervises the functioning of the formal sources of credit. Since they have to follow the rules and regulations of the government or RBI, here there is a control by Reserve Bank of India on these institutions. And urban households are largely depend on formal sources of credit. Urban households or urban people have proper documents and they have collateral assets, so they depend largely on these sources of credit. Informal sources of credit include money lenders, landlords, relatives, and friends. These are the institutions which are self managed and they are out of the reach of the RBI regulations due to their unorganized structure and way of working. Who are money lenders? They are the informal institutions who lend money on the basis of the nearness of the local population. Who are landlords? They are the people who own farmland in villages on which farmers cultivate the crops. Informal sources of credit charge higher rate of interest and use harsh mode of repayment. There is no organization to supervise the functions of sources of informal sources of credit because there is no interference by the government or RBI in informal sector. So they are charging high rate of interest, sometimes 25%, 50% and even 60% also. In informal source of credit, no need to keep a collateral because money lenders happen to know the borrowers personally. Poor households largely depend on informal source of credit because they are flexible in terms of timeline and procedure requirement is less and adjustable according to the needs and convenience of the borrower. Now let's discuss what is the composition of a formal and informal credit in India. See graph 1, sources of credit per rupees 1000 of rural households in India in 2012. If you see this graph, there is informal sector and formal sector loans. Informal sector includes money lender, relatives and friends. So money lender, people take loan from money lender 33%, relatives and friends 8%, landlord 1% and other institutional agencies 5%. Whereas formal sector include cooperative banks and commercial banks, that is 25%. See, rural households, most of the people go for informal sector of loans than formal sector. If you see the graph 2, of all the loans taken by the urban households, what percentage was formal and what percentage was informal? See the first circle, first graph here, 85% of the loans taken by poor households in urban areas are from informal sources and 15% formal sources. Compare this with the rich urban households, last circle, that is 90% of the loans taken from formal sector and 10% high rich households take loan from informal sector. The rich households are availing cheap credit from the formal lenders whereas the poor households have to pay large amount as interest to the informal lenders. Why are credit arrangements not very fair for all sections of the society? Because a rich section gets access to credit on easier terms as compared to poor section of the society. There is a bias towards rural credit as most of the banks and lending institutions are focused on the urban centers of the country. Nowadays, bank officials themselves visit rich people and big companies to provide loan, while poor have to go to the bank again and again. Now we shall see how can the formal sector loans be made beneficial for poor farmers. The process should be made easy for the poor farmers and workers. It should be spread across urban and rural areas. Government should monitor the loan disbursement to ensure that there is no bias against them. There should be incentives for the banks and industry to set up their base in underdeveloped regions of the country. Banks should set up more branches in rural areas. The poor section of the society should be provided a loan on concessional interest rates and terms of credit. This will bring them in the mainstream of credit disbursement process. Now we shall see the functions of Reserve Bank of India. Reserve Bank of India supervises the functioning of the formal sources of loans in India. The main functions of the Reserve Bank of India are as follows. The first one is it issues currency notes on behalf of the central government. Currency notes are issued by RBI in India. And the second one, it issues guidelines for fixing rate of interest on deposits and lending by banks. Here the rate of interest on a deposit, what is the percentage of interest given by the banks to the people who are depositing their surplus money, that is deposits, and rate of interest for the loans. Rate of interest. It ensures that banks should maintain a minimum cash balance out of the deposits they receive. This is nothing but CRR ratio. That means cash reserve ratio. It is cash reserve ratio means minimum cash which a commercial bank needs to keep with itself as per the regulations of the RBI. In India, it is 15%. 15% of the deposits must be kept in the bank. Only remaining 85% should be distributed as a loan. It ensures that the banks should give loans not only to the profit-making businesses but also to poor people and small traders. It is the responsibility of the RBI to look after the overall development of the nation. That is why it is restricting the banks that it should not give loans only to the profit-making businesses, but also it should see the well-being of poor people and also small businesses. They should lend loan to the poor people also. Certain percentage of the loan must be given to the poor people also and to the small businesses also. And the next is periodically the banks have to submit a report to the RBI on how much they are lending to whom and what interest rate. This kind of report periodically banks should submit to the RBI. These are all the functions of the RBI performing for the banks.